Joining us now is Neil Dutta from Renaissance Macro Research. Neil, good to see you. You say it's time for the Fed to cut now. You also say at the current pace, the unemployment rate will hit 4.4% by year end. Now, if you're right and that happens, why not just wait until 2025 to cut? So an unemployment rate, I think, of 5% or less is often considered full employment.
Well, I don't think monetary policy is a light switch, John. It's not on or off. The Fed can be nimble and flexible and recalibrate before things get really bad. And remember, the risk with unemployment is never that it just goes up a little bit. It either goes up a lot, a bit, or barely at all. So I think that that's important to think about. And that's what I mean when I say the trade-offs have shifted. You look at the unemployment rate, it's been rising 0.1% every month for the last 3 months. The last time we saw anything like that was in 2016. If you'll recall, the Fed thought it was going to hike 4 times that year, and it ended up going just once. So I think it's important for the Fed to kind of get on the right side of the 8 ball here, recalibrate policy. We know that unemployment is rising. That means that there are more people out there competing with those that are already working, pushing downward pressure on the wages of those that are working. And at the same time, we know that inflation has been slowing. And we also know inflation is a lagging indicator. So whatever inflation is right now, that represents where policy was yesterday. So to the extent that policy hasn't changed and inflation's still slowing, suggests that there's a little bit of inertia behind both of these things. So I do think the case for cutting is strong. Okay. I do think the Fed is going to cut, frankly, at least twice this year.
Well, you mentioned labor supply. If rates where they are has helped to drive an increase in the labor force participation rate and other measures there, isn't that a good thing?
Yeah, it's a good thing. But, ultimately, it's about the unemployment rate and inflation. I mean, if there are more people looking for work, that's going to put downward pressure on the wages of those that are working. Either, what'll be more likely is that they just don't see their pay increase, which is in fact what's happening. There's a bit of sort of wage rigidity, but that's disinflationary at the margin. I think all that means, that's an argument from my perspective. The fact that the prime wage participation rate's gone up, that's only a reason for the Fed not to cut a lot. It's not a reason for them not to cut at all. And just to keep in mind, the economy is growing at the moment below potential, right? I mean, we know this because the unemployment rate is rising. Mm-hmm. But more importantly, if you look at where GDP was in Q1 and where GDP is tracking in Q2, you're talking about something that's running about 1.5%. The Fed believes longer run potential is around 1.8. That's why the unemployment rate's going up in the first place. I mean, if the economy can't grow at potential, that means that you're not growing fast enough to keep the unemployment rate from rising, which is exactly what's happening. Yeah. So, this is about risk management, right? I mean, tell me what is the right tail for GDP growth at the moment? It's really tough to come up with one. Yeah. I mean, and that means there are downside risks. So the Fed should lean against those risks. It's not a very complicated call.
And to your point about the data we have been getting, that to me was one of the most notable things out of Powell in Portugal last week was the emphasis he was putting on the dual mandate, which up until relatively recently was not being talked about so much. It was really the focus was almost solely on inflation. So it raises the question, especially as you talk about the fact that the Fed needs to start cutting and you're forecasting 2 this year. Rate normalization versus cutting cycle. What does each one look like? What do you suspect we get? Especially knowing that a cutting cycle would probably be signaling that we're on the verge of recession.
Well, I don't know that a cutting no. See, I think that that's part of the issue is that this sort of on and off switch. The Fed can cut sometimes when there's no recession, like 1995, like 2019. I mean, there are times in recent memory where the Fed can cut without a recession happening. And I think this is going to be more like that than something like, 2001 or 2007, 2008. Household balance sheets are fine. We don't have broad asset deflation. We don't have a corporate balance sheet recession. So I think what that does is basically put a limit to how much the Fed can cut. I think it's really hard, at least for me, to see the Fed cutting more than 100 basis points over a one-year period. So if they start in September, I mean, that's kind of where I'm at, because I do think that cutting by that much will probably start to perk things up in, credit-sensitive industries like housing. But that doesn't mean, but the idea is to kind of get on with it soon, so you don't have to go a lot later. You shouldn't be, if you're waiting for it to become so obvious that there's no alternative but to cut, you've waited too long. And I think that's a bigger mistake. So I think, to me, it's about trade-offs. That's what policy, prudent monetary policy is about. And the Fed believes they're running a very tight policy, right? So they should be far more concerned about downside risk to GDP growth than upside risk to inflation. So to the extent that growth has been slowing and unemployment's been rising, that's, I think, what you're getting at with these risks now better in balance. It gives the Fed some space to ease.